had a really good turnout, had a lot of phone calls the last couple of hours, have a couple more calls scheduled for this afternoon. So if you want to connect with me about anything to do with what we're talking about today, maybe give me just a little bit of time after this one concludes, and I am in the rest of the day to take your calls. So for those of you from the Mike Harris radio show, welcome you back. I see a number of people registered this afternoon from Mike Harris's radio program. Thanks for joining us today, and thanks for Mike for giving us the promotions that he gives to us. So if you don't know who I am, if you're new, and there are a few new names on, my name is Charlie Castro. I've been a real estate acquisition specialist since 2009, late 2009. What does that mean? That's a fancy title. Basically, that means that I help both the individual investor as well as the institutional or the hedge fund buyer, guys that own real estate investment trusts. I help those folks sort of identify real estate for their particular portfolio. And we'll talk about that as we go through the webinar today. I've been doing these since like I said, since late 2009, 2010. I've done these with a number of different specialized groups, like Summit Assets Group. Some of you know Lori Graymont up in San Francisco. Lori has a great operation up there. She's in a couple different markets. She has inventory in Atlanta. She has inventory in Birmingham, Alabama. Of course, Aria Reseller did webinars with Greg Mooney for a number of years. Robinhood Financial is Ray Russo. If you've never heard one of Ray's webinars before, Ray is a financial planner and a real estate broker, and he put together a presentation that was sort of geared towards, how would you view real estate as an investment in the confines of your retirement strategy or your real estate investment strategy? How would you look at that through the eyes of a financial planner? I do webinars with AccuPlan and UDirect IRA. I do those at least once a month. We're not going to do anything for the summer months. We won't start again until September. But if you're curious as to the advantages that you may have with buying real estate through a 401k or self-directed IRA, AccuPlan and UDirect are two of the best. We have them on, like I said, at least every month. We'll probably run 4 to 6 with them in September, kind of gearing up for the end of the year push, which is what you get to get a lot of people for tax reasons start looking for, what do I do with my investment strategy closing out this year for tax purposes. So we'll be doing some of that. Yes, I've been a guest twice on Real Estate 360, which is a talk radio show in San Francisco carried by the Wall Street Journal Radio Network. If you're wondering why I was asked to be on those shows, I was asked to be on because the host asked me, you've got experience in dealing with both the individual looking to buy one home through a self-directed IRA, and you also deal with people that, large investors that buy, hundreds of properties every week. And so I do have kind of a unique view of the industry because I get to talk to these hedge fund buyers, which basically just means that I get a free education, right? I get to learn what they know from much of research and time they put into researching this market. For those that don't know, there was $9 billion spent in residential real estate investing in 2013. That's a big number. So the hedge fund guys, the Blackstones, the Havenbrook Homes, they're very prevalent in the market. They're very aggressive in the market, and I do work with them identifying inventory in certain markets. Just some news and notes. I know many of you have been reading this sort of stuff, and I did a little bit of research last week on what's going on in the market currently. And many of you know that have been on these throughout the year. We do this. We started in January talking about what was going to go on in 2014, and now we're more than halfway through the year, and it's been a great year so far. It's actually been the best year for me personally in 2014, as I suspected it might be. But yeah, bubble watch. Home price is still undervalued, but not that much longer. And it says here that only 3% of homes are undervalued. In the 100 largest metro markets, only 76 are undervalued, and 7 are more than 10% overvalued. And I've joked about this for a number of years. I live in Orange County, California. It's a great place to live, great place to raise kids. But real estate here has rebounded to no one's expectations. It's really an interesting thing what's happened here in Orange County, California. So we are rated #1 by Trulia in the country for the most overvalued real estate in the country. That's just fantastic. Of the top 10 overvalued markets in the United States, California has 8 of them. So obviously California is a very overvalued state. The only two areas not in California is Honolulu, Hawaii, which comes in #2, and then Austin, Texas, which comes in #5. Those markets are extremely overvalued. And people ask me, I'm in California for 4 years. People have been saying, well, Charlie, I'd like to do a fix and flip in my neighborhood in California. I'd say that, you just don't get the kind of results in this market that you do in some of these other places. And of course, now you look back and you say, well, here's why. I mean, if you were to buy in Southern California right now, you'd really be buying in the midst of a potential bubble. I think everyone in the real estate market here believes that we're sitting on a bubble, and of course all these other areas as well. And by the way, this is the reason why none of these hedge funds or real estate investment trusts are really investing much in California. Now, if you're looking for the most undervalued places in the United States, here's the top 10, and I did see the whole list. Most of the markets that we're in are on the list. Matter of fact, on this list here, the most undervalued, Akron, Cleveland, Detroit. Detroit's become hot again. It's funny because 4 years ago nobody wanted Detroit. Now Detroit's one of the hotter markets in the country, and for a lot of good reasons too. I mean, when you go as far down as Detroit went, there's one way to go, and that's back up, and that's what the hedge fund buyers look at. And of course, Dayton, Ohio, Memphis, Tennessee. We're going to talk about Memphis, Tennessee today. Memphis is considered to be #1 market for appreciation between now and 2021. So there's a lot of emphasis placed in Memphis right now. One of my better wholesalers is in Toledo. The two markets I don't have much in, I don't do a lot of work in, is in Florida and in Rhode Island. In Florida, here's the reason for Florida. Florida's up, down, all around. Depending upon the time of day, Florida's either hot or completely cold. And so I've just never spent a whole lot of time down there. Providence, Rhode Island as well as to market, but you get a flavor there. It's the smaller cities, it's the smaller towns that are really the places where you still get appreciation, you still get an undervalued market, which means you have lots of room to grow and grow your investment. So this is from Forbes, just 3 things that make a great real estate investment. Number 1 is ROI. First thing you want to look for is ROI. And interesting, this article here says, 4 to 6%. It's a 4 to 6% number in there. And if you're right, if you're in a real estate investment trust, I was reading something just a little while ago in between webinars, talked about why you might consider investing in a real estate investment trust. And that's not a horrible strategy at all. I mean, those are pretty positive returns. It's fairly safe. You got big hedge funds running the business for you. It's not a terrible strategy, but that's their number, 4, 5, 6, 7%. You can get 4 to 5, 6, 7% by investing in a trust, but you can get you can get more than 2 or 3 times that really by doing it yourself. But it's a good strategy. But in most markets that we are in, at least, you're looking at least 10% and up. So you want to look for a market. I tell people at least 10%. If you're getting a 10% cap or 10% ROI, that's cash-on-cash return on your investment. That's a good market to be in. Other people like markets like Atlanta. Atlanta's a market where you can get a really good appreciation in Atlanta. Some pockets there are still appreciating it better than double digits. But the cash-on-cash there is 6, 7, 8%. But number 1 is cash-on-cash rate of return on your investment. That's the number 1 reason why you should look at investment real estate. Second thing is low-risk investing, and it isn't too risky investing. And I'm going to read this real quick because it's really sort of important to understand the difference between a buy and hold, strategy versus a buy and flip. This again, Forbes. All real estate is extremely high risk. Development of real estate, land, tenant, and common investments, private real estate funds, fixer-uppers, etc., all have much higher risk profiles than just simply buying a nice established cash flow investment property. In many cases, you'll never see a dime of your money again because there's so many things that can go wrong. We talk about buy and flips. Many of you know that there was a buy and flip opportunity 7, 8, 9, 10 months ago, and there were a number of people who bought into that opportunity. But there's a couple of things that can go wrong in the buy and flip model. And and they're kind of bookends. The first part is, and the biggest mistake people make is they go into a property and they estimate the repairs to be one thing, and the repairs end up being something else. In other words, they buy a house for $50,000, they estimate repairs are $25,000, and it turns out it's really $50,000 for repairs. Then on the other end of the spectrum is the end game, which is what you're going to sell it for. And so the second common mistake that folks make is they underestimate what they can sell it to. They overestimate what they can sell it for. So that $50,000 house with a $25,000 rehab, they estimated they could sell it at $125,000, but it really cost them $50,000 to rehab it, and they can only sell it for $100,000. That's where people make their mistakes, is on both sides of that. So Forbes is basically saying here, look for something that's done. There's no work to be done to it. It's cash flowing. It's tenanted. You know what you're going to be getting from it. That's the safest place to be. And so when it says, you may never see your dime or your money again, that's true. Unfortunately, that's true. So that's why what I'm telling people in 2014 is stay away from anything to do with a flip. Unless it's a 12-month flip, like you buy something that's worth $80,000, you buy it for $50,000, you sit on it for 12 months. That's a good strategy, but that's not really a flip. That's not really a true fix and flip. but look for stuff that's absolutely finished and done. And then the last thing is management. Have your property management in place. These are the keys to being successful. High ROIs. Don't get into something too risky by getting into something that you think is a good buy, but it really isn't a good buy because there's work to be done to it. And then finally have your property management teams in place. Now, the good news about the property management world in 2014 is this, is that those companies that are quality companies have really been identified in almost every market. There isn't a market that we're in that we don't know who's there, that you can give your property to that'll do a good job for you. And so, I've been saying for a number of months now that we believe that 2014 is the best time to buy. I mean, 2014, we know that the market's rebounded, but we also know that the large buyers continue to buy. Why? They continue to buy because it's still a great place to invest their money. They still see it as the best place to invest their money in America today, is in residential, turnkey, cash flowing real estate. And many people will say to me, well, I've been, looking at doing this since 2010 or 11. I haven't invested yet. Did I miss the boat? Is it too late? Did I miss the peak? But I don't think so. I actually think the opposite of that. I think that 2014 is still the best time to invest. There's a lot of reasons for that. From Bloomberg, from February 6th, about 77% of investors with at least $1 million in assets will buy real estate this year. They consider it to be the #1 alternative investment pick for 2014, with a third of millionaires surveyed saying they plan to buy this year. By the way, all that says is that people with a high level of success, they see real estate as a good place to invest their money. Bloomberg, again, wealthy investors turning to rebounding real estate, fixed income yields remain historically low, equities continue to surge if you buy in the right market, really critical. I work with hedge funds. Whenever I talk to a hedge fund manager, and I deal with two different entities in those groups. One is the buying manager, just the guy that does the buying, and then there's the analyst, the guy that sits in a room and determines which markets to go into. When you talk to these guys, the one thing that you gain from it is that the key to success is finding the right markets that still have room for growth. That's where they focus their attention at. Interesting, Credit.com, this is for 2013, 44% of all sales, a 34% increase from 2012, were made in cash. So in other words, when the home sold, there was no loan recorded at the time of the sale, which means it was a cash purchase. What does that mean? It just means investors are buying real estate. So in 2013, we saw that number jump. A lot of people say, well, wow, the market crashed in 2008. Didn't they get their best deals in 2008 and 9 and 10 and 11? Why are they still buying in 12 and 13 and 14 as aggressively as they are? We'll talk about some of those reasons as we go through this, but the fact is I believe 2014 is still the best time to buy. Prudential Real Estate, if you don't know, was purchased in October of 2012 by Warren Buffett. Warren Buffett was famously interviewed on MSNBC. It was an incredible boom to the investment real estate business back in 2000, I want to say 11. He was interviewed on MSNBC, and they said, do you think buying single-family homes is a good idea? And he went on to say, yeah, it's a great idea. I'd buy millions of them if I could, but I'm not very handy. And what he was saying was that, to do this, you have to have partners. You've got to have people to help you do it. So Warren Buffett, being Warren Buffett, of course, he went out and he bought Prudential Real Estate. It's now called Berkshire Hathaway Home Services. If you watch cable TV, you've seen Berkshire Hathaway advertising now. I thought they would I thought they would continue to fly under the Prudential flag simply because of the name recognition, but they didn't. Now, Berkshire Hathaway Home Services. But this is a poll they took, a consumer outlook survey they took, and it indicated that consumers' perception of residential real estate is increasingly favorable, and the consumers are more committed to buying in 2014 than they were last year in 2013. We believe that to be true, and we've seen that already. We've seen the market shift. We're going to talk about some of them, and there is a market shift we're going to talk about today. But the hedge funds continue to buy, the real estate investor trust continues to buy, and the inventory that's available continues to be there. And so you as a smaller buyer, and I'm assuming most of the people on this are smaller buyers. I don't see any hedge fund guys, and I do get hedge fund guys on here to listen in on this stuff. I don't see any here today, at least not that I know of. But for you, the smaller investor, how do you compete in that? I've talked about the hedge funds and what they're doing, but how do you compete in that? Some keys to success. Number one, you have to buy below market value. The first three here go hand in hand. You have to buy below market value. You have to buy it direct from the selling part. That means no intermediaries, no fat in the middle to give away profit or pricing that should be your profit, not somebody else's profit. So you got to buy direct from the selling party, and do not buy anything that's not off the market. Those three things go together because they go hand in hand. If you're buying on market on the MLS, you're just not going to get the best deal. You're just not. You're going to get the best deal by going out to the wholesalers who find the properties, and I'll talk about what that looks like in a minute. But you want to get them directly from the wholesaler who acquires the property, where you can get them well below market value. That's the key, because there's a hiccup in the market or in the economy or in the world for that matter that affects the housing market. If you buy in well below market value, you're still ahead of the game. Look for both year-on-year appreciation and ROI. A lot of folks say, I want to buy in California. Well, you're not going to get a big cap rate. You're not going to get a lot of appreciation. I want California. Okay, fine. A lot of people say, I still want Atlanta. Now, Atlanta, you still get a lot of appreciation, but you don't get a very good ROI. You get maybe 6, 8, 9% max. You can get both. If you look in the right markets, you can get both cash on cash and appreciation if you look in the right markets. So look for both. Number 5, make sure you got your property management in place. I've said that 3 times now, I think. Property management is incredibly important, but it turns your investment into a turnkey mailbox money type of investment. That's what you're looking for. Understand your strategy. Before you go into this, before you do whatever you decide to do, make sure you understand what you want to accomplish. Understand your goals. I mean, for a long-term, short-term, understand what you want to do, because that really does translate into what you acquire. And then finally, only buy it if it's fully rehabbed and rent ready. We've had some experiences in the last 6 to 10 months where one group in particular was buying property that wasn't finished through a series of unfortunate events. They didn't get finished. And so when you're looking at a property, your best strategy by far is to get something that's turnkey, cash flowing, rented, tenants in there. I'm going to show you some pictures in a few slides of what that looks like, but it's really important that you look for stuff that's completely finished. Okay, so I talked about wholesalers, and a lot of people, when I say wholesalers, they don't really know what that means, and frankly, I wouldn't have known what it meant a couple years ago myself. So I want to paint a picture of what a wholesaler is. Just the first thing I want to say is it's probably not that guy in the suit. A wholesaler is a guy that gets dirty on the ground. He's the guy that lives in the market, knows the schools, knows the crime areas, knows what that house sold for in 2006, knows it's a good deal what he's buying it for now, knows exactly what he can rent it for when it's fully rehabbed. He's probably more of a contractor type, maybe an appraiser, maybe a real estate broker, but not a guy that's belly to belly selling homes to individuals for owner occupants. These are guys that churn and burn, find inventory, rehab it to set HUD specifications, rent it out, and then sell it to an investment group or to an individual investor. That's what a wholesaler looks like. I love this blog by Ken Corsini, not because of what it says. He's saying, hey, it's a good idea to find a wholesaler. This is a great way to find real estate. What I like about it is the date. This is from 2011. Now, what does that mean? In 2011, you could never find the wholesaler because the wholesalers were all working directly with the funds. But as the funds move in and out of markets, these wholesalers more and more were coming to me on these webinars saying, hey, can I profile my properties on your webinar? Because I get great stuff that I'll sell directly to your folks. We're going to show some of those in a minute. I get great stuff that I've rehabbed myself, put the tenant in myself, have a brand new lease in there, but I can give that to the people that attend your webinars. Absolutely, and that's what I started to do. I actually started to do that about 8 months. Well, that's not true. About a year ago, Justin Harrison in Birmingham, Alabama. Some of you may have been on some of those shows. Justin was the first one that came to me and asked to do that. We did a couple webinars, and they went extremely well. People got great properties direct from him, the wholesaler, great cap rates, great market. Everybody's happy. So we started doing that about a year ago, really. But in earnest, when I turned into 2014, I realized that as the market goes up, that you need to find a way to bring the price down to the investor. And you do that by just cutting out some of the people in the middle. So what was born from that was Income Property Headquarters. That's a website that we use. These are some of the markets that we're in. You'll notice those markets very similar to the markets that we saw in a few slides ago that were undervalued markets. Memphis was on there. Toledo, Kansas City, Detroit was on there. Those are markets that we focused in, and there's no secret why. We focused in those markets for 2 reasons. Number one, you can get great deals there. When you look at the numbers in those markets, people look at that and they go, wow, that's a great, that's a great rate of return in that market. And the second reason is that's where all the hedge fund guys are at. They're there for the same reason everybody else is there, but because they're there, there's an outlet, which means there's always a place to sell properties. So the more I can source, the more buyers there are out there to buy them. So most of these properties that are what you call investment properties are going to be out of state. And if you're wondering why, and in 2014, I'm not so sure that a lot of people don't understand this at this point. It used to be I'd spend a solid 10 minutes on these webinars explaining to people why we didn't spend time in California, we spent time in Birmingham, or we spent time in Atlanta, or in Jacksonville, Florida, or in Jackson, Mississippi. We spent time in those markets because those markets created the best yield. It was just numbers. And it's the same thing that the hedge fund guys do. I mean, if you look at San Jose, I use just two cities, San Jose and Birmingham. You look at the price of a San Jose home and a Birmingham home, and you look at it's a similar house in terms of size. Monthly rent, $2,500 in San Jose, $960 in, that's an actual Birmingham house, by the way. I'm going to show that house in a second. $960 in Birmingham. And then look at the rent ratio, and then look at the cash-on-cash rate of return. Those are the same numbers hedge fund guys look at. They look at it and they say, well, you just get a better bang for your buck. Investing in real estate is no different than buying in the stock market. You don't invest in the stock market because you like where the company's located. You buy in the stock market because you like what the company may be able to offer you in terms of returns. Same thing in real estate. And that's how the hedge fund managers look at this. It's simply where do we get the best bang for our buck. So the number one myth is that it's got to be in my own backyard to be successful. Nothing can be further from the truth. Professional property management is going to give you a higher performance. That's just a fact. A property management team is going to do it better than you can do it. They're going to save you more than they're ever going to charge you in fees, and there's going to be less hassle to it. You know that slide we talked about a few slides ago? Yeah, you can get into flips. You may never see a dime of your money, but if you get into something that's cash flowing, performing, there's no hassle factor there. The property management teams in place. I mean, the biggest change you may have to make is if, you know, for some reason you don't like your property manager and you call me up and say, hey, I want to change property management companies. And it's no big deal. That's not a painful process. But there's no hassle factor there. It becomes mailbox money. You know, every month you get your check or your wire from your management company, and you can go online and see your statement, see that, yeah, they deducted for $25 because the kid threw a baseball through a window, and they went out there and they fixed it. No, they don't bug you with stuff like that. Only repairs that exceed $200. They even call the manager. That's typical, by the way. Some companies are more than that, some are less, but generally it's about $200. So if it's a repair that costs $50 to fix, they're not going to bug you. They're going to fix it and take it off the rent, send you a receipt from the contractor kind of thing. But there's less hassle by having a property management team than you have to go do that yourself. There is a trust issue. There's an investment company checklist that I've recently put together that I think is important. And whether you work through me or you work through another acquisition specialist or you work through Property Direct, who sells properties to homes to people like you, however you do it, these are some of the suggestions I make. Number one, make sure you're in the right market. Make sure you're in a region that has good investment characteristics. We'll talk about what that looks like in a minute. When I say no cheap properties, I mean no C properties. I don't suggest C properties. I mean, you can get some good deals on some high Cs, you know, a little above average C properties. That can be okay. But don't get into the C, C minus, D type properties. Stay in the C's, high C's, B's, and A type properties. Don't buy junk, I'm trying to tell you. Just because it's cheap, by the way, doesn't mean it's a good value. Make sure it's a turnkey operator. We talked about that. Make sure the operator you're dealing with provides it completely done, finished. Here's the keys. Your management team's in place. You're ready to go. Make sure the property management team's in place. Make sure the renovations are good quality. I'm going to show you some photos here in a second. It's important that you get quality workmanship done to your property, because if you don't, if they're just putting, you know, lipstick on the pig type thing, right? If they're just doing that, then you're going to pay for that later. So you don't want to do that. Make sure that group has at least 5 years experience in that market, that they know what they're doing. And last but not least, when I say high integrity, it means you got to give me 5 people that you've sold to that you've been successful with. You want to make sure the group you're dealing with has a track record of success. That's very, very important. And then finally, transparency in numbers. I'm going to save that for a few slides. I'm going to show you what transparency in numbers look like. I'm just going to do real quickly here. This will take 2 minutes. We're almost getting to the end, then we can take some questions. Oh, by the way, if I didn't mention, to the right of your screen, there's a chat box. There's a dashboard, and there's a little button in there, and I see that a couple of you have already found the button, because I've got a couple questions in here already. But if you click on that button, a little box will pop up. You can type your questions in. So we'll answer questions at the end of today's webinar. So I'm going to show you what a hedge fund looks at or looks for in terms of investment characteristics, like we talked about in that previous slide. You know, you want to look at what's going on in the city. In Birmingham, for example, they spent $1 million revitalizing the downtown district there. Not just downtown, but the schools, the libraries, the streets. They put a lot of money into infrastructure there. CNN Money says it's now the 8th best real estate market in the country and the 3rd fastest growing real estate market in the entire nation. New Wire says it's the 3rd best cash flow market in the country. If you're curious, Rochester, New York is #1 in terms of cash. I think Rochester overall is about 14% cash on cash. I mean, as I said, they put a lot of money into downtown. And CNN Money at the beginning of the year said, okay, well, Birmingham, of the top 10 hottest housing markets for 2014, Birmingham is number 8. Memphis is number 10. I'll do that in a second. But, they give you some statistics on this stuff. And this is the kind of stuff they read. What's the forecast say by the National Realtors Association in that market? The realtors there will tell you they expect to see no area there decrease in value in 2014. CNN says across the board we expect to see a 7.8% increase. Now, we know from 2012 to 2013, by the way, that increase was 12% in Birmingham, even though there was a drop of 2% during the period of time when the government shut itself down. Many of you may recall, the government, in their brilliance, shut the government down in, I want to say, October, November of 2013. Yes, 2013. And it did cause a slump. It did. It did have an impact on the economy, and it did have an impact on real estate prices across the country. But the fact was, in the real estate market, it was just a bump because it came right back up again because the market was still recovering. So it had a little hiccup there, but it continued to decline. And by the end of the year, it still saw a solid 12% increase in that market. For those of you that were on, I see a number of names, so they've been on these since early in the year. Remember, we talked about in January and February when we first started the new year, we talked about statistics in that market. We talked about, what we saw in 2013. It was solid 12, 13, 14%, depending upon the pocket. But they projected for 2012, and I haven't seen numbers for 2012 lately. I'll do that for my next webinar, but for 2014 rather. But forecasts through 2014 September, they projected to be 8%. It'll be interesting to see how close they came to that number. I'll try to have that number in the next webinar that we do. So to give you some ideas, and I know one of the things that we advertised, and I didn't mention this at the top of the webinar, but yeah, prices have come down in terms of buying ability. The market continues to decline, but in terms of access to inventory, there's a reason this happened. I'll explain that in a minute. But this is an example. This is a 3D property. This is the one I profiled on the San Jose comparison. It's rented at $960. It's asking $60,000. E-appraisal's got it at 80, so you're below market value. And the cap rate's 15.6. Those are really strong cap rates. Now, I'm going to explain why in Birmingham we're seeing this in a few slides, but I can tell you that this is the kind of stuff that you get directly from a wholesaler. And I'm showing this because I talked about quality craftsmanship. It's important that when you look at a property, this is the kind of thing you're looking at. This was built in 1981. It's a newer house. We do have an offer on this house at the moment. We may have another one. We do have one at $64,000 on this property. They were asking $68,000. We have one offer at $64,000. Somebody asked me a question this morning: can you make offers on homes? Yeah, absolutely you can. No different than a hedge fund. You submit an offer. All they'll say is yes or no. But you could make an offer. But anyway, this is a 4-bedroom, 2-bath. It's a bigger property. It's been completely remodeled in and out. Tenant is installed on a 12-month lease at $1,000 a month. Really good rental rate. It's a Fannie Mae property, but the deed restriction came off July 5th, so we weren't able to sell this till July 5th. The deed restriction was lifted. Rent's $1,000, as I said. Built in 1981, so it's a newer property. Yeah, I know, 1981. In California, if it's a 1981 house, you tear it down. In Birmingham, it's a 1981 house. It's brand new. I mean, that's just the way the markets are in the South. And Atlanta's very similar to that. Cleveland, Toledo, Ohio, it's all very. A 1981 house is really considered to be a fairly new house. But again, asking was 64 or 68. There's an offer at 64, and the cap is 14.7. Again, it's important to point out what I'm showing you here. Now, I can show you a whole photo gallery of this particular piece of property, but for the sake of the webinar, I'm just showing you a couple of slides. But you get the idea. This is quality craftsmanship. At any property you consider buying, you want to see a photo gallery of the entire house to know that it's been done properly, and then you have an inspector go out and do an inspection on the house before you purchase the property. Now, let's go back a few years. Many of you recall we talked about Birmingham. Birmingham was once a sleeper town. When we first started working in that town in 2009 and 10, it was a sleeper town. There was no hedge funds there. They were all focused in Atlanta, in Phoenix, in Las Vegas. They were all over the place, but they weren't in Birmingham. They descended onto Birmingham about 2.5 years ago. There was 2 hedge funds as of the beginning of this year in Birmingham, and one of them just burned themselves out. They left about 10 days ago. And when I said in my invitation, I said, you're going to see some prices that you haven't seen for a while. This is what happens when a hedge fund leaves town. When a hedge fund leaves a market, it leaves a void. You've got people there that had inventory that now don't have multiple large buyers. So what do? They lower their prices down, which bumps the ROIs up. For those of you, and I see a number of names that have been on here for a while, if you recall, I think it was 2012 the last time you saw homes listed in those neighborhoods. Now, these are homes that are valued in the mid-40s to mid-50s that they're selling for $31,000 to $36,000. You can see the rental amounts. And look at the caps, 17, 18. There's one particular seller with this group. I only took 4. He's got 24 just like that. And yeah, there's all kinds of data I've got on these, but just for the sake of brevity, this gives you an idea of what happens when one of those buyers shifts markets. Now, they didn't shift markets because there wasn't good inventory. They didn't shift markets because the caps were coming down or the prices were going up. They shifted markets because they couldn't get enough inventory to satisfy their needs. So they moved to Kansas City and St. Louis, which I'm working with them both in Kansas City and St. Louis. I got guys down there working now. And that's a good market too. Love both those markets, good markets. But in this market, the same thing that's going to happen in Atlanta 2 years ago is going to happen in Birmingham for the next 6 months, which is you're going to see prices come down and caps go up. Not prices come down in terms of the value of the homes, but in terms of what these wholesalers will sell them for, because they can't redeploy their money into other inventory until they liquidate their existing inventory, and one of their biggest buyers just left town. So that's what happens when a hedge fund leaves, is prices come down. And again, yeah, I know, $31,000 for a $600 rental or $36,000 for a $700 rental. I mean, those are 17% cap rates. Those are extremely high numbers. The second market's Memphis. I already mentioned Memphis as being the largest, or excuse me, the market that's predicted to have the highest level of appreciation between now and 2021. There's been a couple of studies done, and Memphis is really a strong market. And interestingly, if you look at the Memphis market in terms of graphs and charts, it's a really almost boring market. It's just flat. It just steadily sort of goes up. Yeah, it came down a little bit in 2008 and 9. Yeah, and then it started going back up, but it's really nothing dramatic. Or some of these other charts, these other things you'll see, and they're like, they go way down, they go way up. Memphis is just consistent, just a consistently strong market. Part of it is they've got tremendous infrastructure there. Many people don't know that. FedEx is based there, AutoZone, Nike, they're based down in Memphis. Solid infrastructure, extremely stable housing market. By the way, CNN, and I meant to get the slide in, I didn't have time, but CNN Money says this is the 10th best cash flow market for 2014. And the good thing about Memphis is not only can you get really good inventory, but you can get some of it financed. There's people down there that will carry paper back. I'll explain that in one slide. But you get an idea here, 3-bedroom, 2-bath house, 1,200 square feet. It's already renting for $800 a month. They're asking $59,000 for that property. Zillow says it's worth $85,000. You're well under market value on that. Good thing about this property here is that you can do some financing on it. I'll walk you through that real quick if you're looking for some financing. Again, transparency in numbers, this is what I'm talking about. You want to see all the numbers laid out. So you got projected rent, you get your annual taxes, insurance, your property management costs, your net monthly cash flow. So on a $59,900 investment, your rate of return is about 14%, which is pretty good. However, in this property, they'll sell it with 40% down. So you can put $24,000 down. You got points. You got to pay the lender. By the way, this is a non-recourse loan, meaning you don't qualify. It's not FICO score driven or credit driven. It's an asset-based loan. So it's 5 points, $1,800 bucks. So you're into it for $25,600. It's a 12-year loan at 12% interest. It's assignable. So if you want to sell it, you can sell it. Your net monthly cash flow is $273. So after you pay the note, you've collected your rent, you still got positive cash flow. So if you want to base your ROI based on the $25,800 you've got down, you're still getting 12.7% of your money, and you own a property that's probably worth close to $75,000, $80,000 you bought for $60,000. So in Memphis, there's now some, and by the way, that financing is available on any property in that price category in that market, and that's not the only house. I'm just doing that for sake of brevity. I could do this for the next hour if you all had time. There's plenty of inventory down in Memphis. I was just spotlighting that one piece of property to give you an idea. So that is my webinar. I want to thank you for being here today. I want to thank Mike Harris again for sending some folks our way. Thank you, folks, for being on here today. There was a couple of things in the queue that I read while I was doing this, so I'll answer those just real quickly. The first thing is, yes, I've noted your information. I will get you a copy of the webinar. Yes, I know I talk fast sometimes. I try to do these at least under 45 minutes, and I succeeded in doing that today, so that's an accomplishment. But I will get you a copy of the webinar. The second question I had was, you mentioned Rochester, New York. Yeah, Rochester was considered to be the #1 cash flow market in the country. And the question is, do you have properties in Rochester? And the answer is I don't, but I know some people that do work that market. So if you're interested in looking at something down there, I did do one sale down there, but it was kind of an interesting thing. It was for a guy that was on our webinars a number of times and had a daughter attending school down there. Was looking for a property for her to live in, so he got a really good deal on a property down there. So he wasn't looking for it as a rental or a cash flow vehicle. He just needed it for a family member sort of thing. So I can get property down in that market as well. Okay, I don't see any other questions in our queue here, so I'll just hang out here for a second. If anybody's got any more questions, I'll take whatever question that you might have. If you don't, I'm leaving my information up on the screen. If you'd like to contact me, you can give me a call. I always leave several hours available after these webinars. Okay, and I have another question being typed in, so give me 1 second here. Okay, very, very good question. How can you be sure that the repairs have been done to certain specifications? You get I think I mentioned it, you get an inspector. You get someone to go out and inspect it. That's how you do it. If you live in, if you live in New York and you got a house in Birmingham or Toledo, Ohio, or whatever, and you're not planning on flying down to visit it, you get an inspector to go do it. And by the way, those inspectors are licensed, so they can't go down there and tell you your house is doing well if it's not. Okay, if there's stuff wrong, they have obligation by their license to tell you that. But you get an inspection. I mean, you ask for a full photo gallery, sure, but you get an inspection. But then you talk to the sellers too. Don't think any of these acquisitions are made directly through me. You're working directly with the wholesaler. You go directly to them. You get to meet them, get to know them, and understand what kind of work has gone into that property. I always ask for a scope of work anyway, so you can see what work is done. And then you make sure everything's warranted. So everything that they did work to is all been warranted. So those are things that you want to ask. Any other questions? Okay, I don't see any other questions. Oh, no, somebody's typing in something right now. Give me 1 second here and I'll answer your question. Okay, this is a question about a 401k or self-directed IRA and about tax benefits. Okay, let me answer that question this way. I'm not a tax professional and I can't give you tax advice. Do I know that there's tax benefits in owning real estate? Yes. Would your third-party administrator? Absolutely. That's what they do. I would direct that question to them. If you want to learn about what advantages there are through your self-directed IRA or 401k, I would encourage you to contact your third-party administrator or contact me and I'll send you a copy of one of the webinars I have with either UDirect or AccuPlan, either one. They're both extremely good. And they're free. These guys, they do these webinars with me and they talk to you about the benefits, the advantages, the tax benefits, and all that stuff, and it's free advice. I mean, it's great stuff. They usually take a good 35, 40 minutes and go through it step by step. But I'm not qualified to do that, and so I'm not qualified to say to you, I know there's tax. Matter of fact, I almost did a webinar early this year because I acquired a thing about the top 10 tax benefits of owning real estate. And I was going to do it, and then the light went off, and I said, you can't do that because I'm not a tax professional, and I can't give people advice about how to handle their taxes. And so the answer is I know what those things are. I'm just not qualified to tell you what they are. So, I mean, I can tell you about real estate. I can tell you about the market. I can tell you about where there's good places to buy. I can tell you who the right people to buy from are. I can tell you where you can go be successful. But in terms of helping you with your tax planning or your retirement planning, that's not my skill set, and I would be remiss in trying to give you those answers. So maybe contact me. I can put you in touch with some folks, but I wouldn't be the one to be able to answer that question effectively. Okay, I don't see any other questions, but I left my number up here long enough. I had a couple of texts and I had a couple private messages. So to answer the questions I got on my private text here, I'm here the rest of the day. It's only 1 o'clock here in Los Angeles, so I'm here the rest of the day. If you want to call me, give me a shout. I'll be around. I always leave my phone open. If you get my voicemail, it just means I'm on the phone. I will call you back. So with that, I'm going to sign off. I want to thank everyone for being on today. We had a really good turnout today, considering I didn't start marketing it until I think it was Sunday night or maybe Monday morning. So we'll be doing, I think, one more tomorrow or Thursday. I can't remember what I got scheduled, but we have a couple more going on this week. And we'll be doing a couple more next week, and I can already throw the teaser out there. Next week, we'll be talking about some financing opportunities in Birmingham as well. We've got a non-recourse lender that's lending on properties down there now. I have all that data next week. I hope to be able to unveil that next week too. So thank you all for being on today, and I hope to talk to you really soon.